Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining me. On tonight's program, we have Jun Bei Liu of Tribeca Alpha Plus, and we're going to look at some very interesting stocks that are moving in the right direction or potentially could be moving in the right direction. And then we'll be catching up with Paul Rickard of the Switzer Report to see what we should be doing in this expected rotation out of big cap stocks into other stocks. And the big question is, do you have the guts to sell your Commonwealth Bank shares? We'll see if Paul Rickard's got the guts to do exactly that. Now, let's go to Jun Bei Liu of Tribeca Alpha Plus. Thanks for joining us, Jun Bei Liu.
Thank you for having me, Peter.
Okay, it's reporting season. We've seen some really interesting things. I really thought of you, I think last Monday when A2 milk fell about 18%, but it ended up for the week. So what's going on with A2 milk?
It's incredible. Look, it's when the result came through, there was a bit of disappointment when they talked to, slightly weaker guidance for next year. Now, weaker as in, they are still being very conservative, thinking, Chinese birth rates will continue to be a little bit soft because normally there's a, bit of delay from the marriage, the birth, and then until they buy the infant formula. So, but they expect the market continue to recover. They're gaining share, but they said, consensus is probably getting ahead of itself. Still will grow very strongly in a very weak market, a weak environment. So yeah, we're seeing quite a good, actually good performance in terms of earnings, but share price, investors just not patient enough to wait for another 12 months for the earning to significantly pick up.
Okay, but it actually did rebound over the week, didn't it?
Yeah, it did rebound very strongly.
Okay, so what's your take on it? Is it a company that people should persevere with?
I do think so. It's a very good quality company, and it has taken share, significantly in China when most of the offshore competitors in China are really struggling. And when the market does recover, the growth will be phenomenal for this business.
Okay, let's go to a stock that you talked about for some time. It's had a bit of a challenging period, but it's up about 6.7% today, and that's Jones Ling Group. Now, I must admit, I thought about them when I listened to the IAG result, and they're talking about the costs of fixing up homes and whatever. This is a company that actually has specialized in getting a lot of the business from the insurance company. How come it's risen today so strongly?
Look, it's finally had a bit of reprieve. I think one of the main reasons is that the share prices really shouldn't have declined so significantly in the last few months. The reason it went down significantly is because this company, remember, I always say it's like a climate change company. So when there's a lot of rain, floods, and it actually drives a lot of extra work for this company. Now the pipeline for extra work is still very, very strong for this company, but because of weather is normalizing, people are a bit worried about future pipeline, as in, growth in the next couple of years might be a little bit challenged because those additional work might be a little bit less. My view is that this is a great company in terms of earnings. It's very, very defensive. And like you said, it's locked into with major insurance companies, and now it's growing to the US market and growing over there. It's still very fragmented over there. It will take time to really establish themselves, but the early signs is pretty good. And remember, the US market is significantly larger than what it is here in Australia.
Yeah, but yourself, a lot of Aussie companies have gone overseas with bright eyes and bushy tails and have come home tailless, if you like. Do you have confidence that this company can make it in the US?
Look, we still have to see. They're still very, very small over there. It seems like there's an early sign they're doing pretty well, as in they are getting good contracts. But I think, you probably need another 12 to 18 months to see really how they're tracking.
Okay, so the US, and if you get a good dose of tornadoes and cyclones and excessive rain, these guys will probably do well.
That's right. And it's probably a good hedge against the insurance companies people hold.
Yeah, okay, right, yeah. So just before we go on, do you think it's in the buy zone at these levels?
I do think so.
Okay. This is a company I don't know much about. SRG, but it's also up about 2% today. And it's an infrastructure services company. What do you know about SRG?
Yeah, look, it's actually a really good little company, actually growing really fast. It is very Western Australia centric. And as you said, it's infrastructure services and utility. You know, most of its businesses are really based on, but business are the utility companies, the infrastructure businesses. So
Oh,
very, very defensive earnings and growing fast. And recently, I think last week, they just made an acquisition, bought a business that with a similar sort of business, but with East Coast and Central Australia focus. So really good diversification now, and with good price that they pay for. You know, potentially lots of synergy, lots of revenue synergy to come through in the next few years. It's not particularly expensive because it's still little. So, you know, I do think it looks actually very, very attractive for the growth profile it's offering.
okay. So does this get the Jun Bei Liu thumbs up?
Yeah, definitely.
Okay, right. Yeah. First time I've ever asked you to do that, but you're pretty quick with the thumb. All right, let's go. This is another company I didn't know much about, but in our Boom Doom Zoom show last Thursday, one of our subscribers asked us about it. Kelsian. It's a very interesting company. The analysts like it. What do you think of Kelsian? KLS.
Yeah, that's right. So it's a company that's they own a lot of buses. So you know, for they operate a lot of buses here in Australia, and also they went to the US as well. Of course, I think they might be in New Zealand as well. So you know, it's a good little business. It gives you good you know, sort of tourism exposure. You know, because a lot of them are tourism buses and the like.
Yeah.
And also because it's got big long-term, long-dated contracts, so it's very defensive. Now the problem is today it just reported its result. Result is okay, but I think outlook is a little bit softer. At the same time, it talked to significantly higher capital expenditure required to sustain that kind of growth profile. Now this company is one of the darling stock for many fund managers, so you know, you're seeing quite a significant share price decline on the basis of that. It's a little bit disappointing.
Okay. Yeah, and it also got businesses like Sea Link and Captain Cook Cruises, but of course it is probably suffering because of higher interest rates worldwide, and tourism is down as a consequence. The readings that I've come across is that it's likely to do better in 2025 when interest rates are down and probably tourism's rebounding. What do you think about that?
Yeah, definitely. I do think this is a good business. You know, share price reaction throughout this reporting season actually has been quite extreme, either go up a lot or go down a lot. So, you know,
Yeah.
this may well represent good opportunity. It just there's a few angry sellers out there today.
Okay, angry sellers. All right, let's go to another one that copped it, and is a company that in the past you've liked and I've liked, namely Megaport. It has been sold off. Is it a buying opportunity for the long-term player?
No, I do think so. Although, you know, the growth profile has been pushed out a little bit. You know, we were all hoping to see some form of green shoots. So so then you can say 2025 is the year where you see good growth. The problem is when they reported, the management really talked out those green shoots. So things will take a lot longer before you can see the you know, the turnaround. So, you know, the result itself was in line, but it just the outlook, it seems a little bit disappointing. And you've seen the share price you know, movement, but I do think that, you know, this is for the long-term investors. This represents significant amount of value. It just will take a little bit longer for
Yeah.
you know, to trend the right way.
My argument has been that while companies like NextDC and Zero could arguably be called blue chip tech stocks, these are like the next generation Megaport, and it's going to take some time before it's bedded down and perceived as being a real solid company. I say the same about Audinate, which is the next stock I want to talk to you about. The pair of them to me look like future impressive businesses, but at the moment they're kind of in that transitional zone. Is that a fair argument, or am I talking my own book because I actually hold these stocks?
Yeah, look, I think it's a very actually that's a very much the right way to describe them. Shareholder base is transitioning exactly as you said. So early days investor in those high growth, you know, very young companies, they just want to see the top line growth. And the minute you don't have growth, and they out. And the next level, next stage of investor want to see those companies make money, generate return, have, you know, a consistent return, have a much bigger business, much better strategy. So, you know, so then you transition into next group of investor. And Megaport and Ordinate, they are sort of in that space because they're so fast growing and everyone's earning expectations too high. At the same time, they're trying to build into that profitability as well.
Yeah.
So that's a very very nice way of describing it.
Yeah, I know one of the brokers I talked to about Megaport was, well, he said the report was okay. It's just that we expected more and we just didn't get it. Therefore, we sold off.
Yeah, that's right. It happened to many investors like that. Wait till they become liquid and these investors will be back.
Yeah, okay, right. Yeah. Now, is there any company then that you've been looking at lately? You've seen them report and you've said, hey, this is a good time to buy this company?
Yeah, look, to be honest, there's quite a lot of them, but one of the ones that sometimes people call it boring is Bramble. I thought that was one of the best results in this reporting season. Not only they demonstrate a very strong growth, they also show very good cash conversion. Remember, Bramble never used to report lots of cash. It used to be just fake earnings. And now cash flow is strong. They increase their dividend payout, which shows the management confidence in future earnings. Also, they're paying out special, the buyback. So, I do think this company has a lot further to run, and the result was very good.
Okay, so this is a new phase of Jun Bei Liu where she actually goes after boring companies. This is a new phase for you, Jun Bei Liu.
That's right. Wherever you can make money.
Okay. Yes, making money is not boring. Thanks for joining us. Talk to you in a couple of weeks' time.
Thank you, Peter. Bye.
Well, that was Jun Bei Liu of Tribeca Alpha Plus, and now we have Paul Rickard here from the Switzer Report. Hi, Paul.
Hi, Peter.
Big question now. We saw that big sell-off a few weeks ago. We talked about there's probably a rotation coming out of, in America, tech stocks into other stocks. Here in Australia, probably. And my question to you is it really out of the the top 20 type stocks that have really done well compared to so many other companies?
Look, I think it's probably we're not at the same pace as the US in terms of the rotation. I think that the main reason there, Peter, is we probably need interest rates to start to fall here.
Yeah.
The US can look confidently ahead to an interest rate fall in September, another cut probably in November, and maybe a third one, depending on how big the first one is. At the moment, the market here still thinks the first interest rate cut is probably February plus. And so some of the factors that would help small companies, in particular lower interest rates, are still a little way out.
Yep.
And I think that we probably, if you look at profit season, the outlook statements that have come out of most companies are a little on the soft side. And maybe that's just conservative. I was reading an article about talking that the American companies, their outlook statements tend to be a lot more positive. So
Americans tend to be more
they
positive.
do tend to be the glass half full people.
Yeah. Love those guys. Love those guys.
Yeah. So I think there's probably a little bit. I don't think we've seen much of a rotation. I think we've seen a bit back into health stocks, but it's starting to happen. I mean, our smaller cap indicators are doing a little better, but still some way to travel, I sense.
Yeah. So the point you're making is it's kind of happening, but not at the same pace because our interest rate cuts are further off.
Yeah.
Might be end of the year, could be early next year. So given that, the big question is it time to, or is it getting close to the time we should be looking at having the guts to sell Commonwealth Bank shares?
Yeah, and I've been a little bit of a broken record on this, Peter, because I had guts at a lower price,
Yeah.
and the price is now
no guts, no glory.
No guts, no glory. So around $139 a day. Look, I think they're way overdone, Peter. I mean, the yield of the Commonwealth Bank share is now about 3.4, 3.3%.
Yeah.
There is
Term deposits are now better than CBA.
There is no growth. It's not as though their earnings are going to grow massively. They're not going to grow. In fact, if anything, if CBA delivers a flat, if FY25 is flat in terms of profit compared to FY24, the same big profit, that'll be a good outcome because we've seen a little bit of stability around the net interest margin, but we still have bad debts at record lows, and we have almost no volume growth, and costs are going up at 3 or 4% per annum. So, and it's hard to keep on getting, cutting out costs. They can't close branches because of various things. So it's hard work being a major bank in terms of driving a more profitable business. And normally share prices go up when profits go up.
Yeah.
We're not seeing that with the banks, and they've gone up something like about 30% in the space of the last 6
All
months.
right, now this is all guesswork. And let me say to you that I actually did press the button and sell my CBA shares today. Where do you think the market would say that's if and when it does fall, where do you see the bottom? 110, 115?
Yeah, I think for the company like CBA, which is just so good, so prime, that something around about 110 to 115 would be, I think I'm not expecting banks to fall out of bed.
No.
I just think that they're
Overpriced.
and there's going to be better value elsewhere. And I think you could see probably 110, $115 would be sort of where you target back to. It will only take a little bit of concern either about bad debts or conversely, as margins coming under, not going up again, that the market will start to get worried again. But it's not there at the moment.
Rate cuts, would that be a potential trigger to sell banks?
Yeah, but look, potentially rate cuts are a negative for banks. So they're good longer term in the sense that bad debts won't go up.
A rebounding economy eventually happens.
And a rebounding economy should be good for volumes. But initial impact will actually be to squeeze their margins a little bit because they'll be under a lot of pressure to pass on immediate relief to their borrowers.
Politicians will
and
make sure.
Probably a fair bit of pressure not to squeeze their depositors so hard. So normally rate cuts are a negative for bank earnings. So again, we're talking about that potentially being the market sort of thinking, I think February next year, there's some who are November this year, there's some who May next year. So we're still some way from that, Pete, but that's potentially a bit of a negative, and the market will get back onto that in due course. So at the moment, I think it's a function, as I've said to you before, Pete, that because the commodities market's not roaring ahead, fund managers can't see what to do with the money, right? And so they're not really wanting to go and buy a lot of BHP or Rio or Fortescue because the iron ore price hasn't actually been trading the right way. So they're not investing in the major resource companies as a reweight. And they've been a bit scared to jump onto some of the technology companies because of, question really what the value is compared to the US companies. And so there's been scared to sell banks. I think that'll happen. And I think that some of the retail investors, people like you and I, Pete, and others will say there's better value elsewhere. One stock that does seem to be in a little bit of a beneficiary is Telstra, which I was looking at today. I think Telstra looks all right, people.
Yeah, it's an income play too, isn't it?
It is an income play. It's now yielding 4.7% fully franked. So you compare 4.7% fully franked for Telstra versus 3.4% for CBA. Both are pretty low volatility.
And dominant
players in their industry. Telstra's never going to shoot the lights out, but at least it can actually point to earnings growth and dividend growth. CBA's got none. So I sort of think that although most of our portfolios, we've all got lots of Telstra, at least most retail investors do. That's a stock that I think we're starting to see some institutional monies flow back into. And that's one of the reasons, Pete, it's now back over $4. Despite not doing anything other than you would have expected.
Yeah, I guess if we want to see developments that could be good for both BHP and good for any other stock other than banks, would be a good CPI this week, implying that maybe the rate cuts will come earlier, and also some good Chinese data as well, which might be the harder to expect right now. But by the end of the year, if you're seeing that sort of stuff, it could be good for believing a rotation is going to happen.
Yeah, Chinese data, some positive Chinese data would really help our major resource companies. And I think that would be triggered to, and we do see that on a daily basis. You see either the banks are being bought and the resources being sold or vice versa.
Because Fortescue was up about 6 or 7% on Friday, wasn't it?
So I mean, I think that would help. The other thing that would help is lower interest rates here, Pete, which is important. And thirdly, a little more confidence. So, I mean, that's it. I talked about reporting season. It's been okay. There are certainly some people sort of sensing that perhaps the consumer has bottomed. So we're in the last quarter go back last quarter, there's lots of really bearish data coming through about retail sales. Some of the big retailers reporting pretty zero growth or negative growth in terms of same-store sales. That data in July, August seems to be a little bit better. Maybe that's the impact of the tax cuts and all the other spending from the federal government. maybe there's a bit more consumer confidence starting to occur. As perhaps we get talk of a of a rate cut coming. So I think some of the fund managers are out there are now looking for the consumer-based stocks. That will certainly help the small caps to a fairly big extent. So I think there's value out there. Interest rate cuts, a bit more signs that the consumer has perhaps bottomed. Would be a positive for the smaller.
Okay, so you basically said you suspect CBA share price before the other banks as well.
Yeah, look, I think the way to play the banks is probably you don't need all of them. CBA is there because it's the one that the institutions hold as prime, and it's one they go back to in any problem. So I think CBA, Westpac's had a really good run. Maybe it can go a bit further. So I think probably still CBA and Westpac are probably the two, Pete.
Yeah.
I'm not a fan, as you know, of the ANZ. They will get a new CEO in time. And NAB, it's probably early days with the new team at National Australia.
Okay, now we started off by talking about the top 20 stocks doing really well, and we agreed that CBA is probably time to take some profit on it. What about Wesfarmers and JB Hi-Fi? They've also defied our expectations.
They have defied. So I think the JB Hi-Fi story is perhaps along the lines of maybe the consumer has bottomed, and that's probably more the story there. That's sort of spilling over to Wesfarmers, but again, I think it's a function of the institutions don't know what to sell.
Yeah.
So Wesfarmers, I guess, has got its act together with Kmart, and it's doing well. And Bunnings, again, lower interest rate scenario will help places like Bunnings because that needs, again, a positive consumer to get back onto the sort of the house repairs and all the discretionary spending that occurs in, with the garden, all those sort of things. That needs the consumers feeling just a little bit more comfortable about opening the wallet.
So JB Hi-Fi have the young people signed up who love tech, and Wesfarmers has the old people who can't help but go to Bunnings on Saturday morning for a sausage sizzle and buying something.
So Bunnings reported a couple of days. I think both stocks are very fully priced, Pete.
Yeah, me too.
Look, when we've got global markets at all times highs, and you say, well, to sell the banks, they're the biggest part of the market. It's very hard to know the whole question, where do you put your cash?
Yeah.
And I think that's what we're seeing, that people are just afraid to sell at the moment. And but there will be, I don't think the banks are the most attractive part of the market.
One last thing, I've talked to you about this before. We put some of our financial planning clients in it. That beta shares price X20, which gives you the top 200 stocks minus the top 20. It seems like a sensible play. And I noticed for the last month, it was up about 3%, while the ASX 200 was up about 0.8. So I think I feel as though it's reflecting.
There is a little bit going back, and I think you're right. I think that people are saying there's got to be more value outside our biggest 20 companies, which are dominated by the 4 banks plus Macquarie and the major resource companies. Yeah. So let's look at the list. So I think that there is a bit of money starting to move back, and I think there's more value. Both you and I personally, we've invested in that, and I think there's value in something like that, which is an easy way to play the market X. Yeah, X those big companies.
Those little companies that were belted up because of high interest rates. And by the way, it's not the letter X. You got a question on that? Yeah.
No, I've had a little bit of feedback. What's this X20? X20, and that it's not. That's not the company. Yeah. It's EX20.
X20.
X20. Right? Okay. And that's the ASX ticker.
And that's Paul Ricardo, the Switzer Report. Thanks, Paul. Thanks for joining us. Don't forget, Boom Doom Zoom is on Thursday, but only if you're a subscriber to the Switzer Report. Thanks for joining us. See you next week.